Are you confused about how taxes work when you're day trading? Are you worried about the huge number of taxes you might end up having to pay? Or maybe you just simply want to learn more about how day trading taxes work. If so, keep on watching, because today I'm going to teach you all about understanding how taxes work with day trading. Now, before I get started, this is an important reminder that I am not a CPA or a financial advisor. Everyone's tax situation is different, and so before making any crucial decisions, you should definitely consult a tax professional. They will have all the correct and better answers for you. However, I'll give you as much information as I know, and maybe that can guide you forward. So, the first thing I need to teach you is what a capital gain is. What does that actually mean? So I'm going to use Facebook as an example to explain this to you. Let's say you bought Facebook back in March of 2020 for $150 per share, and you just bought one share. Now let's assume that you waited and waited until the price got all the way up to $200 and you sold it. You made a $50 profit on Facebook. That $50 profit is your capital gain on the trade. This will be super important to keep in mind as we start to look at the difference between long-term and short-term. On the other hand, let's say you ended up buying Facebook all the way at the high up here, around $250 in May of 2020, and when it dropped down to $200 right here, you ended up selling it. That $15 difference that you lost is a negative $15 capital gain, or a $15 capital loss. Now, if you made both of those trades, they actually can offset each other. So the first had a $50 gain, the second had a $15 loss. That means you have an overall gain of $35. You have $35 that are going to be taxed as capital gains. So in the grand scheme of things, you're either losing money or you're making money day trading. Now, if you're losing money, taxes become pretty simple actually. Of course, when you lose money, you don't have to pay taxes. And even better, you can write off some of these losses. So each year we can deduct $3,000 of capital losses from our taxes. And yeah, that number really isn't that large, but the other good thing is this capital loss deduction can carry over. So as of 2020, your capital losses can be used for up to 8 years. This means that if you lost $24,000 this past year day trading, you can spend the next 8 years deducting $3,000 from your capital gains. Of course, anyone who's losing doesn't really want to think about taxes, so let's go into covering the winners. How much do they have to pay? The winning side of day trading, tax-wise, is a bit more complicated. There's quite a few different things to consider here. Before we dive into how much you're going to actually have to pay, let's dive into what you can actually write off. If you qualify as a day trader, you can actually write off expenses for your computer, your internet, your monitors, etc. All these are being used to help you work, to help you generate an income, and they can be tax write-offs. Okay, so now the topic you've been waiting for, capital gains taxes. If you're holding your assets for greater than 1 year, which actually most people are, this is considered a long-term trade. And what that means is you'll be taxed at long-term capital gains tax rates, which are much more favorable than short-term tax rates. And better yet, if you're only trading a small amount, you might not have to pay any taxes at all on these gains. So in 2019, if your long-term capital gains income was under $37,500, you don't have to pay any tax at all on it. And in 2020, the IRS actually moved this up to $40,000. If you made more than those amounts though, you'll be taxed based on these tax rate percentages shown here. Now, if you've never done your own taxes or you don't really understand how they work, just to give you a quick overview, taxes are in marginal brackets. Now, I'm going to give you an example to explain this. Let's use the 2020 capital gains rate taxes, just to make the math a little bit easier. Let's say you had $100,000 in capital gains taxes long term for 2020. You'll fall into this bracket right here, the 15% one. Now, keep in mind, I'm only doing this math for federal tax rates. You'll have to pay a small percentage for state and local as well, but that depends on where you live. So back to our example. You made $100,000 and you're trying to pay your 2020 long-term capital gains taxes. Your first $40,000 are free. You don't have to pay any money on it. It's not taxed at all federally. Then the next amount of your money falls into the second bracket from $40,001 to $441,450. That means that $60,000 of your profit is taxed at 15%. So although your final tax bracket is 15%, you're not paying $15,000 in taxes on your $100,000. You're actually only paying $9,000. Now that's not specific to capital gains taxes, that's how all taxes work. And finally, you can see here that with long-term taxes, 20% is the highest percent rate you'll ever pay, no matter how much you're making in long-term gains. So let's switch it over to short-term gains. How are these taxed and how do they compare to long-term capital gains? Well, just as a quick overview, short-term capital gains count as regular income. They're taxed at whatever bracket you're falling in. So just looking at the 2020 income tax brackets, if you're already making $40,000 a year and then you have $10,000 in short-term capital gains on top of that, that's all going to fall into this 22% bucket, assuming you're single. And by the way, short-term capital gains are anything that you traded for less than 1 year, whether that's 1 minute all the way up to 364 days and 23 hours. So if we just look at our example again, let's say we made $100,000 in short-term capital gains. And just for the sake of this, we're going to assume that that's the only income you made. As a result, you're starting your first $9,875 in this 10% bracket. After that, you'll have some income in the 12% bracket, some in the 22% bracket, and then your final amount in the 24% bracket. So if we run just a little bit of math on those numbers, you'll see that the taxes for these short-term gains comes out to around $18,000, twice as much as you would have paid in the long-term capital gains. The next super important thing to understand with taxes when it comes to day trading is the concept of a wash sale. So what is a wash sale? A wash sale happens when an individual sells or trades a security at a loss and within 30 days before or after the sale buys the same stock or security, or one that is substantially similar. Now, this will actually prevent you from deducting the capital loss. Let's go back to our Facebook chart as an example here. Let's say you decided to buy Facebook all the way up here, around $240. You saw the price dropping immediately, and when we got down to $225, you took your loss. You lost $15, so you have $15 in capital losses now. You think to yourself, great, at least on my tax returns, I'm going to be able to write off those $15. This isn't much of a benefit, but it's something to keep you a little bit happier about the $15 loss you just took. Now, this is on May 27th that you ended up selling it. Let's assume that on June 5th, you saw the price going back up again, and it's $230 now, so you end up rebuying Facebook. This is where the wash sale ends up taking place. You can no longer count those capital losses since you just bought back into Facebook. Those initial losses cannot be counted as capital losses. However, moving forward, if you were to sell Facebook for a loss right afterwards, you can end up counting those. If you're a day trader and making a lot of trades, this gets super complicated, which is why it's super important that you contact a financial advisor. The next thing I want to cover is trading in your IRA account. IRA accounts are basically accounts that are set up by the government in order to help you save for retirement. They either have tax-free growth or tax-deferred growth inside of them. And so as a result, a lot of traders like to use these so that any gains they make while they're trading, they don't have to pay capital gains taxes on, or at least not right now, depending on which IRA account you have. Now, whether or not you do this is totally up to you, and again, a financial advisor can help you make the right decision. But one important thing to keep in mind if you do this is that you're not allowed to borrow, short sell, use leverage or margin, or open naked call or put options inside of your IRA accounts. These are all restrictions you need to keep in mind. And if you want to do any of these, you'll have to use a regular account. The last thing I want to cover is something that you can apply for on your tax returns, and it's called trader tax status. Now, if you trade enough, you might actually qualify for this. There's no official requirements for this the IRS has set up. However, they do have a set of guidelines that they recommend. First off, they recommend that you're trading for at least 4 hours every single day. In essence, this needs to either be a huge part-time job for you or your full-time job. They also recommend that you have no lapses in your trading. So if you're taking multiple months off at a time, you're probably not going to qualify. The third thing is they recommend you have at least 60 trades a month, which ends up being about 3 to 4 trades every single day. The fourth recommendation is that you have a short-term holding period, that your average length that you're holding a trade is 31 days or less. Fifth, they recommend that you have large proceeds from this, and similarly, that you're trading with a large account size of at least $25,000. If you just have a couple $1,000s in an account, or just a couple $1,000s in profit, you're probably not going to qualify. And lastly, they recommend that you intend to run a business and make a living with trading. Now, this can be a supplemental living. It doesn't have to be your full income. However, it does need to be some sort of large income. And to supplement this, they recommend that you have a home trading setup. So all those things aside, let's say you do qualify for trader tax status. What benefits does that give you? Well, that $3,000 deductible loss rule that I was saying earlier, that no longer applies to you. You can write off all of your losses. Second, there are no more wash sales. This rule also no longer applies to you. And furthermore, you can write off almost all of the expenses you have. This includes commissions, borrow fees, scanners and chart data you pay for, parts of your rent, as well as your computer, your internet, and anything else you use to trade. Now, before I end this video, I want to give you one tip that I've seen gone wrong for a lot of people. Let's say you make $50,000 in 2020 trading. You're going to have to pay taxes on this come April 2021. Make sure you keep that in mind, and at the end of the year, set some money aside for this. Don't use your full balance, your new $50,000, to keep on trading, because what if you end up losing it all? You're still going to owe taxes from 2020, but you might no longer be in as much profit. I know I've really drilled this one a few times, but seriously, if you have any concerns or questions or want to learn more about your tax situation, reach out to a CPA or a financial advisor. They can help you best and help you understand what's best for you. Thank you so much for watching. If you like this video, please do click that like button and hit the subscribe button for future content.